The market loves certain stocks, treating them like royalty. Investors eagerly place these elite companies into portfolios, paying premium price tags without a second thought. Look at market darlings like Pidilite and Clean Science. On the surface, they appear invincible, backed by years of consistent growth and market leadership. But the stock market is a two-sided coin. A high-quality company is only one half of the equation. The other half is the price you pay to own it. When you buy a stock at a price-to-earnings ratio of 60 or 70, you are making a specific mathematical bet. You are paying for a future where everything goes right, where there are no macroeconomic shocks and no competitive missteps. This eliminates your margin of safety. By pricing in absolute perfection, you leave yourself no room for error, meaning even a minor setback can lead to a significant reassessment of the stock's value. To understand why the market demands such a high entry price, we have to look at the moats protecting these businesses, the structural advantages that make them difficult to disrupt. Pidilite has turned adhesive into a consumer habit. Brands like Fevicol and Dr. Fix-It are protected by over 100 patents, securing their chemical formulas and packaging against smaller competitors. This chart shows the result of that dominance. Pidilite maintains a 23% EBITDA margin, while its closest peers often struggle to reach 15%. Their return on capital employed has remained steady above 20% for years. Clean Science relies on a different kind of strength, a process moat. They are currently the only company in the world to commercialize certain chemicals using an eco-friendly catalytic process that produces only water as a byproduct. This efficiency allows them to operate debt-free while generating a return on capital employed between 29 and 35%. For many investors, buying an elite moat at a high price feels safer than betting on a struggling business at a deep discount. There is a common assumption that a great company will eventually grow into any valuation. However, the math of multiple contraction can override even strong business performance. Consider a scenario where an elite company is growing at 15% annually. If that growth slows to 8%, the market's perception changes instantly. As shown on this secondary axis, the market responds by re-rating the stock. The price-to-earnings multiple drops from 70 to 40. This red zone represents the resulting impact. Even though the company remains profitable, the shift in valuation causes the stock price to drop 40%. Profitability alone cannot stop this decline. When the rate of growth changes, the valuation multiple almost always follows it down. To see what might trigger such a shift, we have to look at the specific risks that could disrupt the perfect growth stories of these two companies. Pidilite's margins are highly sensitive to the cost of vinyl acetate monomer, a crude oil derivative. When oil prices spike, their profit margins bleed. They also face new competition from giants like Asian Paints and Grassem. These players are moving into construction chemicals with massive budgets and established distribution network. Pidilite production method, their high margins could disappear. As a major exporter, Clean Science is also vulnerable to global supply chain trends. When global customers pause their orders to clear out existing inventory, export revenues can stall regardless of how strong the company's internal process is. Because these businesses are exposed to global economic shifts and aggressive rivals, paying for a flawless future remains a significant gamble. After weighing the strength of these moats against the reality of their valuations, the question remains, are these stocks worth adding to a portfolio? For investors with a 10-year outlook, these companies represent rare examples of businesses that can consistently compound capital over long periods. However, buying at the peak of a valuation cycle risks years of stagnant returns. If you pay too much today, your investment may stay flat for a long time as the company's actual earnings work to catch up to the stock price. Instead of buying immediately, the more strategic approach is to keep these companies on a watch list. The goal is to wait for the moments when the market panics. Temporary shocks, like a spike in oil prices or a global macro scare, often create opportunities to buy these high-quality businesses at more reasonable prices. Strong businesses build long-term wealth, but the entry price determines the quality of your return. You can respect the moat without ignoring the valuation.
If you like our video, please like, share, and subscribe.